Welcome to the channel. I am Sam Erekeosima. This channel we discuss basically everything that I'm working on, everything that I'm interested in. And today I wanted to give you an update on kind of my thoughts of what's going on with the economy, looking at the macro of everything and kind of just telling you what I think is going to be happening and what I'm actually doing regarding my portfolio and different things that I'm working on. So I want to take it back to last week. So last week we had the Fed meeting on Wednesday. The Fed, as expected, they said that they're keeping interest rates the same. They're not increasing interest rates. They're not lowering them, they're just keeping them the same. Now, the expectation was that they weren't going to do anything. But although this happened, and everyone knew this was going to happen, the actual stock market went down. And first, let me just say, everything that I say is not financial advice. It's just entertainment and my thoughts and things that I'm doing. So with the Fed actually keeping interest rates the same, the market did not react well to that, and the market went down. Part of the reason that they reacted so poorly was because the way that the Fed chair, Jerome Powell, was actually talking, he was acting like there might be a chance that he might even later on increase interest rates. He was talking basically what they would say is very hawkish and just saying that the economy was doing well, unemployment is doing well, and there's no need to cut interest rates. Now, markets love interest rates cuts. They like easy money. When interest rates are low, it's easier to borrow money. It's more accessible. Businesses now can borrow money and expand their businesses, hire employees, and do different things. So it's actually pretty good for the economy. Now, the downside of low interest rates is high inflation. And the Fed actually has a dual mandate. They have two things that they are required to do. They're required to keep inflation low and unemployment low. But typically when you have one, you do not have the other. When you have low interest rates, you typically have low unemployment, but inflation actually rises. So for the past couple of years, ever since 2020, and we had COVID-19, the Fed actually printed a lot of money, and a lot of money went into circulation, and that made interest rates go up very high. We went up, I think, as high as 7% at one point. Now we're sitting at about 2.7%, and the goal for the Fed is to keep it around 2%. So they're not quite at their target, but they're well far from where they started when they started cutting rates to really, raising rates to keep the inflation down. Now, there's a lot of back and forth that you've probably been seeing with President Trump. He's been telling the Fed chair to actually cut rates, and the Fed is not cutting rates. And he's called him an idiot and talked a lot of crap about him. But, Jerome Powell is pretty adamant about keeping rates high at this where they are to keep inflation down. Now, what happened in the next couple days might change things in the future. So on Wednesday, he announced that they're keeping rates the same. And then on, I think, Thursday, we had unemployment data. The unemployment data said that unemployment actually went up, right? And unemployment goes up when rates are high because businesses are less likely to hire people, they're less likely to borrow money, they're less likely to expand. So now we're starting to see unemployment go up. It went from 4.1 to 4.2. Not a large increase, but it is showing that there's weakness in the labor market. People are not getting hired as much, people are getting laid off, and unemployment is rising. So when that actually happened, you saw a little shift in the expectation for the next Fed meeting, which is actually going to be in September. So now, after that unemployment data came out, it actually said that there's almost like an 80 to 90% chance that they are going to actually cut rates in September. The market typically does like those types of things, but the market still did not react well because on Friday, August 1st, that was the tariff deadline. And a bunch of new tariffs or existing tariffs were started to be cemented. So tariffs are a big thing because tariffs can affect inflation. So when the news came out, I think we got 25% tariffs on India, 25% on, or 15% on the European Union, and then China has 30%, and I think Canada also, Mexico has 25%. So all that tariff news, the markets never like it because it actually weakens the economy because now consumers have to spend more. It makes businesses less likely to do trade. So the market actually went down even more on Friday after those tariffs were announced. Now, for me as an investor, I'm always looking at this macro, the big picture, because Fed policy, monetary policy dictates typically what happens with business cycle, and I'm a big proponent of real estate. Dictates what happens with real estate, right? Because when interest rates are high, people don't want to borrow money to get a mortgage because now their payments are higher. So, interest rates affect a lot of the market. So I'm always looking at the macro, seeing what's going on with the world and the economy to see how I'm going to maneuver and make certain decisions. Now, with the tariffs coming down on Friday, the market reacted poorly. The market actually went down a pretty good percentage. S&P went down and all those things. Now, the funny part to me is back in April when Trump first announced these tariffs, April 1st, the market went down like 10%, a really big drop, which is honestly looking back was the best time to actually enter the market. When there is fear in the market, when people are scared, that's actually when you want to be buying, right? When there's uncertainty, all those things, because over time, the market will always go up, right? We saw it happen in 2020 during COVID. It tanked very badly, but then it actually went back up. And, some people try to time the market, but time in the market is better than timing the market. So when you see these big dips, those are opportunities to buy. And if you ever see those in the future, I would definitely say you really want to look at, where your positions are and how you're going to be able to allocate capital to get into positions, because those are opportunities that you're not going to see for a while. Because since that August 1st tariff and we saw that big drop, the stock market has almost recovered completely. Actually, has recovered completely, and it actually touched all-time highs. So we're actually sitting at all-time highs. The news on Friday made the stock market come down, but guess what? On Monday, the stock market rallied again, right? So whenever you see dips in the market, those are opportunities to actually allocate more, to get more into the market and do different things. Now, for me, I'm looking at real estate, I'm looking at different things, and I'm like, how can I position myself, right? The way I see things over the next, let's say, few years is AI is really going to create a stronghold. Technology, disruption, those are the things that I like to invest in. I like to invest in tech, disruption. With that being said, NVIDIA to me is probably one of the best companies to invest in right now, because they're actually making the chips that are going to be producing the AI computers, the robots over the next 5 to 10 years. And I think over the next 5 years, we're going to see a massive shift in how the world is and technology. And I think AI is going to just become more and more ingrained in our world. And the people who actually use it are going to be able to position themselves to actually have a lot of financial gain from it. Now, with that being said, I think there's another sector that an area where people who are getting into this field are actually going to be able to do extremely well. I think a lot of the white collar jobs, financial services, different things like that, they're actually going to be the number one area where AI may be taking their jobs. Now, the blue collar jobs, specifically if you are a skilled trade person, electricians, plumbers, carpenters, they are going to be in high demand because there's not enough of those people, and those jobs aren't going away to AI. You're always going to need a plumber, you're always going to need an electrician, always going to need a carpenter. So if you become a skills trade person, you have the opportunity, I think, over the next few years to actually become a multimillionaire if you get your license and you could actually grow different businesses. I think those businesses are going to do extremely well. Now, again, my overall thesis for me, my financial plan is to own assets, right? I want to own assets. I want to own real estate. I want to own stocks. I want to own digital assets, businesses. You want to own things where, as the market goes up and down, you're always going to have an opportunity to participate in the growth, right? So that's my strategy and what I'm trying to do: build a real estate portfolio, build a stock portfolio, have digital assets, build different businesses, and really try to grow wealth through those different areas. Now, with that being said, I think the next topic that I kind of wanted to talk about is the digital assets, specifically Bitcoin. I think now with a lot of laws that are being passed in the past, few months since Trump has become president, it's become pretty clear that, you know, crypto, specifically Bitcoin, Ethereum, some of the other things are all, to me, Bitcoin has kind of cemented itself as it's here to stay, and it's being regulated, and you can hold it in your different exchanges and things like that. Now, when it comes to Ethereum, a little bit more risky to me because that's more speculation, because it's more of a technology type of thing, and with tech it moves very fluidly. But I think Bitcoin has kind of cemented itself as a store of value, and as we've seen, it's went from what I think it was last year like 50,000, now it's at 100 and almost 20,000. 100, and today it's actually about 118,000 after going down to 115 on Friday, or 114 on Friday. So with that being said, you want to own assets that will be able to go up in time. And by the way, one of the reasons why Bitcoin goes up over time is because it's a hedge against inflation. It's a hedge against a weakening dollar. As more money is printed, the value of that money declines, right? That's why when you go to the store to get eggs, it costs you $8 when a couple years ago it only cost you $2. It's not that the eggs are actually that much more better or that much more valuable. It's just that they printed so much money, it cost more of those dollars to get the same amount of eggs. And that's why real estate also does well, is because it's not that real estate has gone up and it's worth so much more now. It's just that the dollar is weaker and it costs more dollars to buy the same house, right? So that's where a Bitcoin comes in, because you can't print more of it. It's a fixed supply, 21 million. And people are starting to realize that. They say, oh, I can hold this. And instead of, people printing more dollars, I can hold this. And there's not going to be inflation in that way, where now I hold this asset and it's going to actually hold its value. So, again, those are just different things that you can kind of invest in. I think, to me, it's still business. If you can create a business, you have the most opportunity to create return, because you're actually growing the business. You're doing different things to kind of make it go up in value because you're doing the work. When you're investing in a stock, you're relying on somebody else to do the work, and you're basically giving them capital to grow that business. But when you are the business, or you start a business, you're taking on that responsibility of making that business grow. So that's kind of my thought process and things like that. So long story short, again, invest in assets, own assets. And it's interesting that with all this tariff noise, and people think the economy is going to do bad. Last week we've had earnings for different companies, and in the S&P 500 companies, 80% of those companies have beat what their earnings expectations was. So this may be a little eye-opening for some people, because tariffs were supposed to bring earnings down, and there may be a one-time drop off from those earnings. But I think it's going to be interesting, those companies that were complaining about the tariffs, saying that they're going to have to pass those extra costs to the consumer and charge more, they're still profitable, right? And I think what the tariffs is going to do is going to allow companies to just have reasons to increase their price on goods without them actually taking losses on it, right? They're claiming that they're losing money, but as you can see in this past few months since the tariffs have really started, they're still profitable. So I think that's something to keep an eye on over the next few months, and kind of really see where that lands. But long term, again, own assets, and really figure out your financial strategy. For me, I'm trying to create financial freedom, doing different things. My main vehicle is real estate, but I'm open, and I look at different areas where I can learn and really kind of see where things are going. Tech, again, I think is going to be huge. AI. So, I would just say, going forward, really try to figure out what assets you like, buy those assets, build those businesses, and really try to grow your wealth. If you stayed this long for the video, thank you. I know it was really long. I was trying to keep it, under 10 minutes, but went a little bit longer. And if you stay this long, again, thank you. If you like this type of content, follow. I'll be doing more of these types of videos where I'm just kind of talking about macro or different things that I'm working on. Also, if you want to, in the comments, put what your financial strategy is, right? What assets do you like? What do you believe is going to allow you to be able to grow your wealth over time, and things like that. So again, thanks for watching. We'll catch you on the next one.